Upbeat, confident intro music fades out. Everyone's panicking right now. You've probably seen the comments. The market's collapsing. I'm selling everything. Stocks are down. Crypto's down. Even the so-called experts on TV look nervous. So, let's talk about what's really going on, why it's happening, what it means for you, and how smart investors are quietly using this chaos to get rich while everyone else freaks out. The S&P 500 just had its biggest one-day drop in nearly 2 years, over 3%. The Dow fell 2.6%. The Nasdaq down 3.4%. On the surface, that sounds terrifying. But the truth is, market drops like this don't come out of nowhere. They're like earthquakes. The small cracks form first. If you know what to look for, you can see them before the big shake hits. Let's break down the 4 real reasons behind this mess, so you know exactly what's happening and how to move. First, the recession fear. Investors hate uncertainty. The moment someone whispers recession, the market reacts before anything even happens. Right now, the US added only 114,000 jobs in July, below expectations. Unemployment ticked up to 4.3%. The highest it's been since 2021. Doesn't sound like much, but it triggered something called the Sam Rula rule that's predicted every single US recession since World War II. Now, before you freak out, even Claudia Sam, the economist who created that rule, said this time might be different. Why? Because unemployment isn't rising from mass layoffs, it's rising because more people are re-entering the workforce. That's actually a good problem to have. Still, consumer spending is slowing down. McDonald's and Walmart both said customers are cutting back, and Wayfair reported sales are down 25% from 3 years ago. So yeah, people are nervous, but not everything points to a full-blown recession yet. Even Goldman Sachs only raised their recession odds to just 25%. That's a 1 in 4 chance. And if things start looking ugly, the Fed still has plenty of tools to support the economy. Which brings us to the second reason. Interest rates. Every time the Fed cuts rates after a peak, a recession often follows. And guess what? They're about to cut again. But context matters. In 2022, the Fed raised rates because inflation was out of control. Remember gas at $5 a gallon and groceries up 20%? Now, inflation has fallen from 9% to around 3%. So this time, rate cuts aren't a panic move. They're the reward for beating inflation. Lower rates mean cheaper loans, more to spending, more growth in. That's bullish for the long term. Third, tech stocks are dragging everything down. You've heard of the Magnificent Seven, right? Apple, Amazon, Google, Meta, Microsoft, Tesla, and Nvidia. Together, they make up about 31% of the S&P 500, so when tech sneezes, the whole market catches a cold. For the past year, everyone's been hyped on AI. It's been the buzzword of the century. Every company was suddenly AI-powered. But hype always fades. Apple's Apple Intelligence launch under Nvidia delayed its next-gen Blackwell chips. Meta and Microsoft depend on those same chips, so the ripple effect hit everyone. Even Warren Buffett's Berkshire Hathaway sold nearly half its Apple shares this quarter. That's your signal when the calmest investor alive trims his biggest position. You know, valuations got too hot. Don't get me wrong, AI isn't dead. It's just been overpriced. The same thing happened during the dot-com boom. Hype builds the wave, and reality eventually pops it. Finally, the Japanese yen. This one's sneaky but powerful. For years, investors borrowed money in Japan at near zero interest, converted it to dollars, and poured it into global assets. Then, the Bank of Japan raised rates just a little and boom. The yen got stronger. That meant those investors had to repay their loans in a more expensive currency, forcing them to sell off their assets, which dragged down global markets. It's like a domino effect across continents. So yeah, all these things combined have created the perfect storm of fear. But here's the thing. Fear creates opportunity. I've been through the dot-com bubble, the 2008 financial crisis, and the 2020 crash. Every single time people said, this is the end. And every single time, the market recovered and hit new all-time highs. Here's how I play it and how you can. 2. Step 1. Buy when there's blood in the water. It is a cliche for a reason it works. When everyone else is panic selling, you buy the dip, but only if you have an emergency fund of at least 3 to 5 months of expenses. Never, ever invest money you can't afford to wait on. Step 2. Dollar cost average into a low-cost S&P 500 index fund. That just means buying at regular intervals, no matter the price. Some weeks you'll buy high, some weeks you'll buy low. But over time you average into a powerful position. If you'd done this during the 2008 or 2020 crashes, you'd be sitting on massive gains right now. Step 3. Diversify. Most people think they're diversified, but if all your money is in tech, you're not. I like having a mix. Total US stock market funds, some bonds, and yes, even a little crypto. Not because crypto is safe, but because it's when one market dips, the other might pump. And step 4. Think long-term. Selling in a panic is how people lock in their losses. If you had sold everything in March 2020, you would have missed one of the fastest rebounds in history. A $1,000 investment in the S&P 500 that fell 30% back then recovered completely within just 7 months. Timing the market feels smart, but time asterisk. In asterisk, the market is what makes you rich. Right now, the US economy is still solid. Unemployment is manageable, inflation is cooling, and the S&P 500 is still up over 9% since January. Market corrections, which are drops of 10% or more, happen roughly every 18 months. This isn't doomsday. It's just part of the game. There's a quote I love. When the market goes up, it takes the stairs. When it goes down, it jumps out the window. That's exactly what's happening right now. We've just fallen fast after climbing for months. But history tells us one thing. After every window dive, the market gets back up, dusts itself off, and starts climbing the stairs again. So instead of running for the exit, position yourself for the comeback. Build your cash reserves. Keep investing consistently. Learn how the game works, because this crash, ISNT, the end it est, the setup for the next generation of millionaires. If you found this helpful, drop a comment with what you're investing in right now. Hit that like button so more people don't panic sell their future. And subscribe because I'll be here to show you exactly how to build wealth while everyone else waits for the perfect time. Spoiler alert, that time is now. Thanks for watching.